Welcome back, explorers of Web 3.0. In this video, we embark on a voyage into the intricate realm of tokenomics, uncovering the fundamental principles that underpin the value, distribution, and potential of cryptocurrency tokens. Let us first understand the driving forces behind a token's value, starting with supply and demand. The tug-of-war between supply and demand shapes the intricate dance of tokenomics. It's vital to scrutinize both the circulating supply of a token and its total eventual supply. Imagine a scenario where a token currently priced at $10 has a circulating supply of 1 million, but the total supply is slated to reach 10 million. As more tokens enter circulation, the initial $10 price is likely to decrease, unless, of course, there's a surge in demand or a measured approach to supply growth. When assessing a token's value, we encounter terms like market capitalization and fully diluted value. Market capitalization reflects the total value of tokens in circulation, offering a snapshot of the token's present worth. Conversely, the fully diluted value encompasses the token's complete value based on its current price, providing a glimpse into its ultimate potential. Comparing a token's present price to its all-time high, ATH, is a common practice. However, this comparison can be misleading. For instance, if a token once soared to an ATH of $100 and now trades at $10, it might seem poised for a 10x gain. Yet, this analysis overlooks the possibility of a substantial increase in token circulation between the ATH and the present. To gain a more comprehensive perspective, evaluating market capitalization paints a more accurate picture of the total value tied to tokens in circulation. Decoding token allocation and distribution. Token allocation and distribution form the cornerstone of effective tokenomics. Delving into a token's distribution table unveils its intended allocation among various stakeholders. An optimal allocation entails team, ideally, less than 15%. Advisors, combined allocation below 10%. Early investors, allocating less than 25%, with exceeding 20% signaling caution. Public sale, around 10%, with surpassing 10% raising concerns. Marketing, 10% or less. Ecosystem, at least 10%, emphasizing community engagement. Treasury, over 15%, ensuring vital working capital. Liquidity, below 20%, with a focus on stability through locked liquidity. The significance of allocation distribution becomes evident when assessing its impact. A substantial allocation to early investors, unlocked over a short period, can lead to market saturation as these investors, buoyed by significant gains, flood the market with tokens. Balancing act of vesting for sustainable growth. Vesting serves as the mechanism for controlled token distribution among stakeholders. Unlike immediate distribution, vesting ensures a gradual release of tokens, preventing market disruption. Finding equilibrium in vesting is paramount. Overly restrictive vesting can deter potential investors, while lenient vesting might trigger a rapid token sell-off by early investors, causing price volatility. A comprehensive vesting schedule, releasing a modest percentage for early investors, combined with gradual distribution and reasonable cliff periods, ensures market stability. Demand and value accrual. Heart of tokenomics. Token demand hinges on various factors, including incentives for holding, utility, the potential for acting as a store of value, and the strength of the community backing the token. Incentives like staking rewards or yield farming play a pivotal role in driving demand when their attractiveness matches or surpasses comparable alternatives in terms of APY. Tokens that can act as stores of value or are bolstered by robust communities can also drive demand. Additionally, tokens that offer tangible utility within specific ecosystems can create significant demand. Value accrual mechanisms further shape token dynamics. Deflation, often achieved by burning tokens, reduces supply and enhances demand. Locking mechanisms, rewarding long-term holders with higher APY for committing to extended holding periods, create a supply shock by keeping locked tokens out of circulation. Additionally, utility expansion and APY play a role in value accrual, but careful consideration is necessary, as high APY can lead to rapid supply growth, potentially diminishing demand. The trilemma of inflation control, holders, and locks. Navigating the trilemma of inflation control, holder encouragement, and token locking is a delicate endeavor. High APYs can trigger inflation and selling pressure unless counteracted by a control mechanism. Balancing high APYs with mechanisms like locking tokens for a specified duration ensures holders are incentivized to commit, creating a supply scarcity that can drive demand. Striking this balance, however, is a challenge, as long lockup periods can discourage potential holders. Tokens that master this trilemma often thrive, achieving low inflation or even deflation, encouraging users to hold through enticing incentives, and employing token locking mechanisms establish a strong foundation. Yet, it's essential to note that APY is not the sole means of encouraging holding. Some projects rely on community engagement to foster long-term commitment, even in the face of inflation. Tokenomics in action. Evaluating tokens. Evaluating tokenomics requires a nuanced approach, considering each token on a case-by-case basis. For instance, a token with a significant impending supply increase may appear unfavorable at first glance. However, if the increase occurs over a longer period, the presence of a robust community, deflationary mechanics, and utility expansion could mitigate concerns, warranting a closer look. Similarly, token distribution matters. If a token reserves a substantial portion for early investors, distributing these tokens over a longer timeframe can alleviate potential market disruption. Tokenomics is a holistic analysis where no one-size-fits-all strategy exists. Unlocking the secrets of tokenomics. In your quest to understand tokenomics, here's a checklist to guide your exploration. 1. Supply and demand balancing. Delve into both circulating and total supply, considering market capitalization and fully diluted value. 2. Token allocation and distribution. Scrutinize the token distribution table, emphasizing balanced allocation among stakeholders. 3. Effective vesting. Evaluate vesting schedules, favoring gradual releases and reasonable cliff periods. 4. Demand factors. Assess demand drivers like incentives for holding, utility, store of value potential, and community strength. 5. Value accrual mechanisms. Grasp deflation, locking mechanisms, utility expansion, and APY's role in value growth. 6. The trilemma. Grapple with the interplay between inflation control, encouraging holders, and token locking. 7. Case-by-case evaluation. Understand that tokenomics is multifaceted, requiring a tailored approach to analysis. Almost all you need for thorough tokenomics research can be found in a project's white paper or website. If information is scarce, engaging with the project's community can provide insights. However, a project that withholds tokenomics info might raise red flags. With this knowledge in your arsenal, you're well equipped to navigate the world of tokenomics, armed with the tools to assess a token's potential for success. Disclaimer: the information provided is for educational purposes and not financial advice. Always conduct thorough research before making investment decisions.